So, good morning, everyone, and welcome to this webinar in our series looking at trusts which have won one of our entirely quant-based ratings for 2026. Shortly, we'll be hearing from Emily Fletcher, one of the managers of BlackRock Frontiers Investment Trust. BRFI has had a really strong year, albeit with some volatility this year in 26. And shortly, we'll be hearing about that and what's been driving the portfolio, and indeed on any other topic you'd like to ask, as we have time set aside for questions at the end of the presentation. So please do put your questions in the box on the right, and I'll put those to Emily at the end. So Emily, over to you.
Fantastic. Thank you so much. Well, good morning, everyone. It's great to be here. Thank you so much for joining. And I hope you're all surviving the hot weather. Luckily, in the BlackRock office, we do have high volumes of air conditioning, and I spend most of my time having to wear extra jumpers. But to everyone who is not so fortunate at the moment, I hope you're all surviving. But let's get on with talking about the excitements of frontier markets, countries where the temperatures outside are often similar to what the UK has today. So we can fully imagine we are currently in a frontier market as the weather is today. So we're going to talk about a set of countries that are global. You can see coloured in red here just sort of how wide some of the geographical spread of some of the countries that we're invested in at the moment is. And it is a really interesting universe to talk about. So one of the first questions really is sort of how do you define what you mean by when you say frontiers universe and what you can invest in? And really we invest in a universe that's made up of small emerging countries defined by MSCI and frontier countries and everything else in the whole world below that. So if we think that there's around 20 to 25 developed markets globally, we don't invest in those. Then we also take out the top 7 largest emerging markets across the world. So we don't invest in China or India. We don't invest in Korea, Taiwan. We don't invest in Brazil or Mexico, and we don't invest in South Africa. Now, by taking out those countries, we take out about 85% of the MSCI emerging markets index, which those 7 countries represent. We would invest in the remaining 15% of the emerging markets index. We invest in all of the countries that would be classed as frontiers, and we invest in all countries that are standalone countries or don't feature in any index. And you can see on the left of this slide a representation of our portfolio split by country, and you can see just how diversified it is across multiple countries. Now, we think these countries are really interesting because I would contend that they are underinvested in pretty much everyone's portfolio. So I would contend that if you were to look at your portfolio, then the strong likelihood is that you have very little aggregate representation in Kazakhstan or Pakistan or Saudi Arabia, and that it tends to be an area that is really overlooked. I think if we look at the companies that we invest in, we tend to find there's very little analyst coverage of these companies. Sometimes there's no analyst coverage at all. And that actually is really interesting because it creates quite a lot of opportunities for alpha generation. You can find inefficiencies in some of these markets more easily. The other thing I would say is a lot of these markets and stocks that we look at are predominantly invested in by domestic investors. And that particularly creates opportunities in countries where there's, say, utilities stock in Poland, for example, and a lot of local investors and local analysts have maybe 1 or 2 utilities stocks in that, so 1 or 2 stocks in that sector, in that country. And so that's all that they cover, and all that they know is those 1 or 2 companies. And I think, therefore, there's a big advantage to being able to say, well, okay, well, let's look at the utilities sector, for example, globally, and what are the trends that we can see of how this sector's developed? What are the ways in which in other countries or in more developed markets this sector is being valued, and what are the sort of future revenue drivers that people are looking for, and therefore, how can we find opportunity? I think, therefore, there's a huge advantage to being able to look globally versus some of the other market participants that we find who are very much focused on a single country. So I think that really does give significant potential for alpha generation. And then as we'll go on to look at, we do believe that these markets are quite undervalued. And that I think is just because they're rarely accessed and they're poorly understood. And that, again, just really creates opportunities, I think, as you're looking globally to really make comparisons. Well, how should a company in this sector be valued, in our opinion? I think that part of why there are these opportunities is because if you were to even look at some of the regional funds in emerging markets, and I think if you look at Asian funds, I'm sure if you have presentations, which I'm sure you listen to from Asian fund managers, they will spend most of their time talking about whether they are invested in China or India and the relative merits of whichever one they prefer at the time. And they will spend a lot of the time at the moment talking about tech. And what it is they like about tech and where they're finding opportunities. I imagine that most of them don't talk to you about their great new investment in Pakistan, despite being Asian fund managers. And I think similar is true if you look at LATAM fund managers. The majority of them would spend their time focusing on talking about Brazil and Mexico rather than some of the smaller countries. And I'm not sure that there are many EMEA analysts still employed running EMEA funds, but South Africa would certainly feature highly where there are. So in terms of what we do and how we do it as a team, it's really important to us that we spend a lot of time traveling, we spend a lot of time meeting people and forming relationships in all of the countries that we travel to. So in addition to what you can see in these beautiful pictures, actually Gordon was in Georgia 2 weeks ago, Sam was back in Indonesia last week, in Qatar as well. So we spend a lot of time as a team really traveling. Interestingly, for the 30 countries or so that we have in our portfolio we've invested in sort of over the last couple of years, I would say there's sort of no economies of scale. Looking at 30 companies in 30 countries is much more time and effort and intense, sort of work consuming than looking at 30 companies in one country. There's just no economies of scale at looking at multiple countries. And the reason for that is a contention that we have for these markets, and I think for emerging markets more broadly in general as well, but that actually in these countries, equity markets are positively correlated to fixed income markets and positively correlated to currency markets. So you have a scenario where all do well. So when your currency is booming, so is your equity market, and it's a great time to own local currency debt as well. And then you have the inverse time, which is when you really want to be owning none of them, because you might have your lovely equity that's an exporter of steel, and you think, oh well, maybe it's going to do okay because it's an exporter, but actually, you end up seeing your company go down on the stock market, and you end up also losing money on the currency at the same time. At the same time, its debt yields probably blow out, and you lose even more money there. So that positive correlation means that it's really important not just to be addressing what's happening in the particular company you're looking at and its earnings trends and how they're going to do, but also considering what's happening in the political situation in the country, considering what's happening in the balance of payments, what's happening in the government spending, and really understanding the full macro and political picture in order to be able to take a view on whether or not you are in one of those sort of good times when everything's going up, or those bad times when everything's going down, and you really want to have zero in that particular country. For us, that's also one of the reasons why we think that it's important to have a global mandate, because it does allow you to step out of countries and say, look, I think the policy direction here is just going in the wrong direction, and it's going to be a couple of years before we really want to come back to this country, and they need to sort out a couple of imbalances that have built up in their government spending or politics or something like that. And the benefit of having a global mandate is that you're able to do that. But so that you're not looking at the same beautiful pictures, let's go through a few more slides as I continue to talk. So what are the reasons why we think that this could be an area of the world that's worth looking at? Why should we look at these smaller countries? They're a tiny percentage of the benchmark. No one's really going to see that, even if they do well on a massively relative basis, it's not going to probably hurt anyone's relative performance because they're so small in indices. And that's kind of shown how small they are on indices on this slide. And in terms of the extent to which these countries are represented in MSCI ACWI, it's at 0.1% weight. So really, in total aggregate, they're absolutely irrelevant to global market movement. But it's interesting, isn't it, for countries that house 34% of the world's population? Looking at a stat like this is about the worst indicator of future performance you could ever get, along the lines of sort of urbanization trends and good demographic trends. These are things that perhaps in the long run will matter, but are unlikely to have a market impact in the next 1 to 2 years, which is probably about the sort of time horizon that I think that as equity analysts, we have good forecastability. But it is something that I think on the longer term suggests that entirely ignoring all of the countries in this space is perhaps too much. Why is entirely ignoring all of the countries too much? Again, you know, something of what you see in these pictures is not going to drive equity markets in the very short term, but it is interesting the level of change you can see that's happened in the last 25 years now. And I think the pictures in Saudi are just amazingly stark. I love these two because you can see the same wonderfully shaped building in the two of them. And the level of urbanization change, the level of social change, the level of economic change we have seen in both these two countries that we found pictures for has been phenomenal over that time period. And I think we will continue to see faster growth in these countries than we see globally in global markets in terms of levels of GDP. Again, it's not a determinant of market performance in the next couple of years at all, but does provide a strong underpin for, you know, perhaps why in 25 years from now things could again be very different in these countries. And another interesting one, so occasionally we get new countries that we can access, and Uzbekistan is the newest country that we have in our portfolio, and the first time we've had any really direct exposure in Uzbekistan. We've had exposure there for a couple of years through we own a bank in Hungary that has quite significant exposure in Uzbekistan, and another bank actually that also has exposure here. But Uzbekistan is a very interesting country. The government there is very keen to start to develop its own market, to start to get more international investors, to start to put Uzbekistan a little bit more on the international stage. And as a result of that, there has been opportunity to have exposure in Uzbekistan for the first time. So really interesting, I think, to be in a place where, as a fund, you do have opportunity to start to add new countries where there's very little investment exposure at the time. Again, you know, really adding that ability to get exposure to things that are a bit more unusual within the fund. So I said I'd come back to why valuations are attractive, or why we believe that we can say that valuations are attractive in this space. You can see on the slide that both our benchmark and our fund are at discounts to more developed markets, however you define more developed markets. And I think actually the level of the fund at the 8 times PE is one of the lowest levels we've had relative to the fund's history. This trust was launched in December 2010. And Sam and I have been working on it since it was launched at that point. So I can say that it's at 8 times PE level is both cheap in an absolute sense and relative to its own history for the fund. At the same time, you can see here that that PE multiple is also cheap relative to more developed markets. We've used MSCI ACWI here. So cheap on an absolute basis, cheap relative to its own history, and cheap relative to more developed markets on a PE basis for the fund. Obviously, defining a PE basis for a fund is a hard thing to do. You've probably got something at 100 and something at 1 times, you know, and everything else is somewhere in the middle. But on an aggregate basis, we do feel that there's quite significant valuation opportunities in the markets that we're looking at. So this is another interesting slide, and I think one of the just very, very interesting and probably still surprising aspects of looking at a fund that's invested in this universe is that on a daily basis, the average movement of our portfolio is less than we see on really any other equity portfolio run on the floor here, BlackRock equities, fundamental equities, which is really surprising to people when you think that we have a fund that invests in Pakistan and Nigeria and Egypt and Argentina and Kazakhstan, all sorts of other countries, and yet we can run a fund that in aggregate has lower volatility than funds run in more developed markets. And the reason for that is what you see on this slide, is that the countries have little correlation between themselves and each other. So there's low correlation between, say, Kenya and the Philippines. If we take a step back and think about, well, why would there be low correlation? I think it does make sense. And I often use the example of Bangladesh and Chile, just because they're right at the top on the slide. You think about Chile, highly educated, highly developed country, very urbanized population, geographically very high in nature, 10 big exporter of copper and gold, most key political relationships probably in its region, so Argentina, where it shares a border, maybe Brazil, probably the US. If we look at Bangladesh, on the other hand, there's almost no commonalities. So Bangladesh is obviously coming out of a very difficult political period where it had a caretaker government. Probably key political relationships are with India, maybe with China. In terms of exports, Bangladesh's biggest export is textiles. It's actually very low lying geographically. It's got a very high population density. It's got very low levels of education. It's just very, very different. I don't expect that most people in Chile could place Bangladesh on a map, or people in Bangladesh could really place Chile on a map. I think there's almost no direct trading relationships between the two. I think whatever outcome we'd seen in the recent Chilean election, it would have had no impact on the Bangladeshi population. So you can see it makes sense that the correlation between the two is extremely low, and you can see here sort of effectively zero. And you can sort of replay those correlations, or those linkages potentially across all the countries on this. We've just tried to pick a selection that's sort of globally relevant on the slide, because if you put everything on, it's too busy. And because of the fact that, as I was trying to say at the beginning, that you need to look at each of these countries' political situations, economic situations, FX situations, export situations individually, but they don't really have any linkages on what's happening. Perhaps to one or two countries that are neighbouring them that are in a similar position, but generally across the universe, that's just very idiosyncratic in terms of market moves. That does result in this benefit here, that correlations between the countries are still very, very low, and therefore you end up with a fund that in aggregate shows low volatility. So what sort of thing do we have in our portfolio? Well, one of the benefits, I think, of investing in companies and countries that are fairly ignored by sort of the global investment community is, one, that we have stocks that still look quite cheap, but actually also we have good underlying companies. So we would say that majority of the companies we're invested in do grow earnings kind of 10 to 15% a year, have consistent payout ratios, and therefore, interestingly, we do tend to see that the fund is paid into it quite nice dividends, and obviously we just pay them out, and hence the yield that you see. But that progression of dividend per share over time, with obviously a bit of a blip around the COVID era, which I think in these markets is very understandable, because raising debt is not nearly so easy as in the US or UK, and there really weren't any government handouts. But sort of with the exception of the COVID blip, we've just seen that sort of nice progression of dividend per share. And that really comes from the fact that the underlying companies we're invested in have just seen a nice progression of earnings per share. Not as cool or sexy as what you see in the tech sector at the moment. We don't have many companies that look like Hynix in terms of their share price movements, but kind of boring, old-fashioned, nice earnings per share growth on a year-to-year basis, and companies paying that out at dividends means we pay that out to investors. And that, I think, is sort of what we're invested in. You can see on this slide the split of our investment by country, and you can see the various different countries we have represented. I was thinking to try and bring that to life a little bit more. I'll give you some examples of the sort of companies we're invested in some of these countries. So starting sort of at the top, Saudi Arabia, one of the companies we're invested in does health insurance. They actually do mandatory health insurance. Compliance with that at the moment is probably around 70% level. So you can see, for a product that is mandatory, that the government is trying to enforce, they've got up to 70% compliance. There's still quite a long way to go, and therefore should be some very nice growth over the next few years as we go from 70% compliance to probably more, hopefully sort of in the 90s of compliance. I'm sure they won't get to 100% compliance. So very nice backdrop to that growth to that company over time. UAE, we're invested in low-cost carrier, obviously a lot increasing interconnection across the region, into South Asia as well. That low-cost carrier has been doing very well, taking market share. Kazakhstan, we've got an e-commerce platform, but interestingly trading on, I think, about 6 times PE with about an 8% dividend yield. Kind of not the sort of valuation you would expect for something that's still seeing very high levels of growth at top line, sort of above 20% growth year on year. In Egypt, we're invested in some companies that are exposed to microfinance. So formal banking penetration in Egypt, I think, is still like low 30%. If you add in what's happened through the microfinance sector in the last 5 years, you take that up to about 60%. So some just amazing levels of growth in penetration, bringing people into the formal banking sector we're seeing there, and some of the companies doing really well and growing on the back of that. In Indonesia, we're investing in a clothing retailer, particularly one that's doing kind of athleisure, similar trends to what you see in the West, doing well, growing penetration there. It's quite a difficult environment in terms of the macro backdrop for Indonesia at the moment, but interesting company there. Thailand, we're invested in a land developer, particularly as we're seeing outsourcing from China to other regions, so of tech companies. So as the world is trying to split into sort of the West and China and trying to split their sourcing so that not everything in the AI supply chain is sourced from China, we're seeing a lot of companies kind of moving their manufacturing out into Thailand, a land developer that's really benefiting there from some of the AI trends and the strong tech demand that we're seeing globally. Kenya, we have a really cheap bank, I think, that's trading on sub 3 times PE. I think stocks that are trading on sub 3 times PE are kind of interesting where you're seeing strong underlying growth, good earnings quality, good trends. We did actually buy that one when I think it was sub 2 times PE, but it's done quite well. You come on to somewhere like Pakistan, we have a company that originally started in the cement sector, but interestingly has been buying up stakes from multinational companies as they've all wanted to exit the country in the past sort of 5 years, but when the economic situation was very difficult. And so they're now present in the auto sector, they're present in the pharmaceutical sector, they're doing some nice generic drugs there that's growing quite well, and seeing very significant growth and expansion in that company as well. So perhaps just gives a little bit of colour of the sort of companies we can access and what we can invest on more of a bottom-up basis in the universe. You can see here the top 10 that we have in the portfolio. I think what's kind of interesting is sort of the number of flags we have showing there. So you can see it's pretty globally diversified in terms of the exposure that we have across various different countries. You can see the performance here. I think Thomas referenced the performance. 2026 year to date was a little bit more difficult for us through the Iran war period, but actually interestingly as we come out of that we're starting to see quite a lot more opportunities come back, I think, and it is going to be really interesting that whether we end up where we end up in things like the oil price. Can we end up with a lower oil price even than where we started the year as we come out with perhaps a lot of oil in storage, a lot of oil products in storage? And I think we go back to the environment where we have quite benign global liquidity. And in that environment, a benign global liquidity, I think, with where we've seen the oil price come down to already, I think that's already removed some of the fear around inflationary pressures that people were concerned about over the past few months. And potentially, we see that even come down further, which would, again, even further remove some of the inflation pressures that were potentially talked about, perhaps even to a more benign level we had at the start of the year. I think we'll continue then to see interest rates come down. They're still very high on a sort of post-COVID hangover in a number of these countries. Surprising, we're still talking about that in 2026, but we are. And I think as we start to do that, then you get pickups in activity, in growth, and you should also get a benefit into your cost of equity, into your multiples coming through in some of these countries as well. So I think that should provide quite an interesting backdrop to go back to seeing a real acceleration in growth in quite a number of the countries that we're invested in, especially at that smaller end, the countries at the smaller end of the spectrum, so the more unusual end of the spectrum where we're invested. So I think in order to leave a little bit of time for questions at the end, I'll just sort of summarise what we think we offer in this trust. So I think that this is a trust that offers growth with a lot of the countries that we're invested in growing faster than what we see in the West, growing faster than in more developed markets. At the same time, because of the low valuations, you end up with a trust with high yield, just a pure consequence of the pay through of dividends of companies that are trading on low multiples. As you see, those cheap valuations, and you get all of that in a fund that actually offers remarkably and low volatility, just from the fact that these countries are not very correlated to each other. We think the investment trust structure is a brilliant way to access these markets. It allows us to be active in where we want to be invested. So we will have zero in lots of the countries that we like at various points. We think they're at the wrong point in their economic cycle. We aren't ever forced to hold countries or positions in countries for liquidity reasons, and so we can have that true flexibility of being invested exactly where we think that investors should be on that sort of 3-year time horizon. We spend a lot of time, as I said, thinking about where we are in macro cycles, FX cycles. So really making sure we understand what returns will be in dollars. You can't hedge in any of these countries. You need to just get the macroeconomic environment right. And the trust is set up with a 5-year life. So it's just been through one 5-year life. We now have about 4.5 years to go until there will be the ability for any investor to exit at NAV less costs, which we have found to be a fantastic discount control mechanism. So I think there we are. That is 1 minute over the 25 minutes that I was asked to speak for. And now I think we've just left a few minutes. If there are any questions, I'm happy to answer literally anything on pretty much anything around the world, anywhere. You know, and even my child's cricket score yesterday, if you really want it. But Thomas, are there any questions that I can answer?
Yeah, we have some questions already from the audience. Got about 15 minutes set aside, so if you're in the audience, please do keep your questions coming in. We have one question on liquidity. Could you give a bit of an idea about how you assess liquidity when it comes to both your purchase and also sales of assets?
Sure. So I'd say actually in the portfolio we have, I think we don't really have anything that trades on a liquidity of less than $1 million a day. So although it is a closed-ended structure, although I talked about the benefits of being able to own slightly less liquid stocks, actually everything probably is maybe a little bit more liquid than you might expect given those comments. If you had a Bloomberg terminal, you can value absolutely the entire portfolio, absolutely everything in less than 10 seconds. Everything trades normally. It trades completely as you would expect, say in the UK. It just trades on a less usual market rather than trading in an unusual way. It is really important to us, exactly what you're saying, that we're thinking about not only can we buy stocks, but can we get out of them, and particularly can we get out of them if things go wrong. You know, and you know, we've got the investment case wrong, which obviously does happen as well. So there's nothing that's unlisted. There's nothing that trades by appointment. It all trades completely normally. We have a fantastic in-house dealing team that do know these markets really well, so are able to help us access liquidity as and when we need it. So it's more, I think, that we are looking at stocks that trade in unusual countries. Often actually in those countries, there can be the blue chip names in those countries. And rather than we're trading on something that's extremely esoteric. At the same time, we believe that going back that view on macro, that view on, you know, where are you in the fixed income cycle, where are you in the currency cycle, you know, is there going to be a balance of payments problem? Should I be anticipating that there's a build-up happening in currency here that just doesn't look sustainable, is a huge part of what we do. And if we're worried about something, then we tend to just exit the country. There's so much opportunity. We don't need to have FOMO. We don't need to be anywhere. We have a wide enough spread universe and set of opportunities that if we don't like something, we really do vote with our feet. And we think that's quite an important feature of what's helped our performance over the last 15 years, that we are prepared to do that. And so we expect that that will also be a function of the future as well.
Now, you mentioned Indonesia. You had a question on your views after a pullback in the market there. Are you finding opportunities, or is the political situation too difficult? And I guess it's worth mentioning that I think Indonesia is possibly going to be downgraded from emerging to frontier status. Of course, it'll still be in your universe, but is that significant at all?
Sure. So first of all, on the downgrade, so we've just had the MSCI announcement that we were waiting for. I think it came out earlier this week. And Indonesia is not going to be downgraded for the moment, so it will stay in emerging markets. I think analyst consensus sort of across the market at the moment is that that's likely to be the case for the foreseeable future, rather than just, you know, this announcement. That Indonesia has done enough so far in addressing some of the problem areas that it probably shouldn't be downgraded. Obviously, you know, no one ever has perfect foresight. In terms of what they were addressing, there were some signs of kind of market abuse, market manipulation, insufficient reporting of free float in some smaller stocks that were included within the MSCI index. But it looks like they've done enough in terms of addressing some of the ownership issues in some of those companies for the moment. So what are we concerned about in Indonesia? You're right, the market has done really badly, as the questioner said. And on the back of that, we have seen some policy change from the government. We have seen some action from the Bank of Indonesia. So interest rates have been raised a little bit to try and counter some of the outflows that we saw from domestic residents. So people are getting a bit worried about the political situation, getting a bit worried about policy direction. And we were starting to see some capital flight from residents who are saying, well, actually, I'm a bit worried about what's going on, so I'm going to just put my money in Singapore for the moment. On the back of governments or the central bank having raised interest rates, and we see that actually across the bond curve, we have seen yields go up quite a bit. There will be a level at which the domestic investors are likely to say, okay, well, I am a bit worried about going on here, but now I can get 7.5% in Indonesia. You know, that's quite tempting compared with my very low rate that I'm getting in Indonesia on my dollars. So at some point there will likely be a shift back to some of that money coming back into Indonesia. There will be a policy clearing rate. The question is, are we there yet? And I think our contention would be that we haven't yet seen quite enough shift back to orthodoxy in terms of government policy or interest rates being raised highly enough from the central bank to really reach that tipping point yet. I think we are still seeing some level of intervention of government policy that we haven't quite reached that. But we are certainly in a much more attractive situation than we were a year ago. So actually, I came into this webinar a tiny bit late because I've just been on the phone. But words! I was just on a call with a very good Indonesian economist, and we were discussing exactly that, like how high would rates need to go, how much would the currency need to move how much would government need to change their policy direction until we get that point when Indonesia is interesting. So I would say we're at the point of kicking the tires. I don't think it's quite there yet for it to be moving up to one of the countries we're really, really interested in yet. But very much an active discussion. And those would be the areas that we're looking at. Do we believe in the government can keep fiscal deficit to the level that they've targeted? Are they moving expenditures sort of off balance sheet so we're not seeing them to kind of fudge that? So is it a real target that they're giving? Where are interest rates? Are they high enough yet? Do we think they still go higher? Where is the currency? Do we think it still needs to move out more before we reach that clearing level in having that discussion?
Excellent. And we had a question about the Middle East. So obviously in the short term, there must have been some impact from the conflict, which happily seems to be winding down. How are you looking at those markets now?
Great. Yeah, that's a very interesting question. Yeah, it's really interesting the markets that moved during the conflict and which ones that didn't. Saudi was solid as a rock as a market through all that conflict time, whereas the UAE market actually sold off quite a lot during that time. I have to say that wasn't something that we as a team expected. We actually were anticipating that the conflict could happen. We spent quite a number of meetings discussing what was the likely outcome if we saw a conflict. We didn't expect it to be a conflict like what we've seen in terms of length or intensity, but we had seen a very small conflict the year before, and we were worried that we could see something like that again. So we had a lot of discussions around, what should we do? How do we prepare for this? What could we put in place in our portfolio? What should we do? And I have to say, the one thing I think that we didn't anticipate and we did get wrong in thinking about it was that the Saudi market would be solid as a rock, whilst the UAE market wouldn't, because we think that the two are both impacted, both in terms of being able to sell oil externally and the impacts that we saw on their population, which thankfully weren't too bad, but obviously could have been worse. In terms of where we're going back to now, it does look like we have a good chance of resolution, and I think that would very much be to the benefit of both the world and being able to access oil again, and so the US, and to Iran, which is then able to sell its oil again, and maybe has the advantage of being able to be brought back into the international fold and more widely than that, which I think would have a huge benefit, obviously, for their population. And negotiating terms around that are very important. But I think that if we do get to that point where we can go back to where we were, then I think markets should go back to where they were. Particularly, actually, and the one we would be probably more excited about at the moment is in the UAE, where we have had quite a lot of markdowns as a result of the conflict, whereas in Saudi we didn't get those level of markdowns. If we do end up with a scenario where oil prices are significantly lower post-conflict than they were pre-conflict, which potentially we could do, given there's a lot of oil in storage, as I think I've already said, a lot of oil products in storage. and we will obviously, in all likelihood, have taken away that sort of risk premium of there potentially being a conflict, then I think that will have potentially some impact on where governments were looking at very big projects and how they spend on them for the future, which probably has a bit more impact on Saudi. Equally, though, I think we will get spending directed into investing in oil pipelines so that we don't end up quite so hostage to shutting of the Straits of Hormuz again. So a lot of the governments in the Middle East are talking about how they build pipelines in order to try and diversify their exports, or have the potential to diversify their exports in future, which obviously would entail quite a significant amount of government spending. In terms of wider, so I think we quite like the UAE at the moment. Saudi is sort of cautiously optimistic on some opportunities, but perhaps a less wholesale sort of positive view on the country. Positive on Egypt, you can see from our exposures, where we think that actually we've got a really good economic team in place at the moment, very technocratic, and are actually doing some very good changes there. We have started to see a bit more FDI come into their oil and gas sector, which could have great impact for them if that starts to bear fruit. In terms of some of the smaller countries, we don't have much at the moment in Qatar, Kuwait. Always looking for opportunities, potentially coming out of this, we might find stuff where stocks have been a bit marked down, but at the moment we've got less exposure there.
Hi, Thomas's computer has just died, so I'm just going to ask another question, which is, would you consider moving to quarterly paid dividends?
Well, that is an interesting question. I'm probably one for the board. I'm not sure we've ever actually discussed it at a board meeting. It's certainly one I can put to the board. Interestingly, we actually are in a situation where if you were to go through and analyse the dividends that are paid, where almost all the dividends that we collect are paid in, or the very vast majority are paid in April, May, June. So it was quite a discussion when originally to even go to a semi-annual dividend, because I reckon it's about 80% of the dividends are paid in April, May, June, because the very vast majority of the companies we invest in pay once a year, which again is unusual, I guess, compared with more developed markets. But I think probably because of the fact that the dividends are paid in such a concentrated manner, and I think we also aligned them with when we do the half-yearly report and the annual report, and we report only on a half-yearly basis. I expect it might present some challenges, but I have never been asked before, so I will certainly ask the board and find out a better answer, so that at least I'm giving the right answer, and they may well consider it. So thank you for the question.
I'm just checking if Thomas has managed to come back on, but I think unfortunately his tech has actually failed. So unless you have any closing remarks, Emily, I think we'll probably wrap up the webinar there, if that's okay.
That's great. Well, I mean, hopefully everyone on the call knows exactly where we are. If you have any questions at all, please do reach out to me, or reach out to Harrison or the investment trust team, and we'd be delighted to answer absolutely any question. So thank you all very much for being here. Have a fantastic morning, and it's great to have the opportunity to be able to speak to you all. Thank you so much.